So guys, in this video, we're going to talk about the segmentation of your accounting records. What is segmentation? Basically, most companies, they track their P&L as a one group of items. There is a revenue, cost of goods sold. They have some breakdown of their indirect costs, and that's how their income statement looks like. Basically, just a one column of items. They do not track any breakdown, what actually makes this income statement a little more meaningful to other people who are trying to invest in the company or who are trying to understand how the company operates. Therefore, we're going to walk through what can be done to make the income statement and your balance sheet and any other management report you're trying to use segmented. So let's go through the process. So first of all, you need to identify what kind of revenue streams do you have. It can be product lines, it can be geography, it can be contract types, like you have fixed price contracts, you have your T&M contracts, you can have your recurring contracts, one-time contracts, or revenue streams. You have to develop the meaningful breakdown of your revenue streams. Then you need to essentially assign that type of the revenue stream to each contract, agreement, or anything what makes money for the company. You need to make sure with your accounting records have that segmentation assigned. And then you also need to make sure what your cost of goods sold, which is essentially your direct cost spent to make sure that revenue is generated, can also be segmented. So the way to do it is in your accounting system, doesn't matter what that is, you need to create those tracking categories. And then for every single general ledger transaction ID, you need to make sure what you assign that tracking category to that. And if you do it right, now you can have an income statement what looks like that. It breaks down your total column into the three separate subsections, and now you can see how much money you really make across the three separate subsections. So like right now, instead of looking at one column for 63%, you now have three different products, each making different amount of gross profit. And that can make a difference for the company. Now you know where the money should be invested in, what kind of product revenue stream you want to grow the fastest, because that makes you the most money. So the other type of segmentation is the indirect cost. So right now we essentially have, before we segmented it by revenue streams, we can also segment our indirect cost by what's called department. Can be your back office, which is accounting, HR, any other back office functions. Can be your sales, production, management, any other. So, but it's the same logic for every type of indirect cost on a general ledger level. You have to create that tracking category, and you need to make sure what you assign that tracking ID to every line item. And this way you can understand how much money you spent on different types of categories and how much each department is worth you and is costing you, and also what can you do to improve that. All right. I hope that video helped you to understand the concept of revenue and cost segmentation and why is it important. All right. See you in the next video.